at this point in time. All right. Good time to welcome in our next guest then. We have Somnath Mukherjee, CIO at ASK Private Wealth with us to give us a sense of what they're making of the market. Somnath, thanks very much for joining in. I'll start with exactly that point that I was making. I just picked out one stock. I don't know if you could hear me, but Kirloskar Oil. And really that tells us the story of this market, right? It's so polarized. If you're in the right mid-cap, then you will say, what bear market? What sideways market? Otherwise, if you're just well diversified, hoping for the broader index to move higher, then it's just been, this patient game for the last year and a half. Just tell us how you're thinking and feeling about the market, given that we've recovered from the lows, and what's the overall construct?
Yeah. Morning. Good to be here. I think the market's sort of getting used to being a barbell kind of a market, as you mentioned. There are some areas of the market that's doing exceptionally well. And then there's a broader market that's not sort of reflecting that same enthusiasm. Part of the reason, of course, is the nature of holdings in these respective areas. Places of the market that has been hit the hardest have been the areas or the spaces where foreign investment or foreign investors have had the maximum holding. So the selling pressure has been maximum there. And areas of the market that has performed well, and these are sort of sporadic and kind of a little randomly distributed. Those areas are typically the ones where foreign holdings are relatively, and therefore selling pressure from foreigners has been relatively less in those sort of counters. Essentially, the market is a weighing scale today between three sets of investors, right? There's a domestic institution, there are the Indian promoters, and then there is the foreign investors. Most of the buying has come in from the domestic. So counters that has had the sellers being more than the buyers have suffered. And there is also the other thing, which is the composition of the index today represents the winners of yesterday. So as the index sort of changes in the next few quarters and years, we will see some of the newer themes that are emerging, which are today, or the green shoots of that today are getting reflected in the market, get reflected a lot more in the indices per se. We will see the markets also reflecting that. So I think it is a phase of both consolidation and a massive amount of churn in terms of where investment dollars are going or where investor interest is getting to. And that's getting reflected in the somewhat barbells shaped performance of the market itself.
So let's talk about these newer parts of the market, which you're saying will eventually make their way to the index, and that's when the index level returns improve. So now let's start by getting your thoughts on this. Clearly, the market is chasing renewables, data centers, anything which is tech related. Have you found enough good opportunities in the market in these arenas, in mid and small caps? And what about the pricing at which these stocks are available?
Yeah, no, that's a good point, and I think the theme is somewhat broader than just tech. To be honest, the absolute deep tech opportunity of the sort that you see in several parts of Asia in bits and pieces, and obviously US markets as a broad bread, that is missing in India. We don't have those sort of companies in the listed space, or too many of those companies in the listed space in India. But the real theme in India that's playing out is one, that of inflation. I think globally we are getting into a phase where after close to 2 or 3 decades of low to declining inflation, we're probably getting into a phase where we'll have a period of higher inflation than what we have seen before. And a lot of the sectors that are going to benefit out of that are the ones which are inflation hedges or they benefit from inflation. So hard assets, commodities, materials, energy. Along with that is the point that you made that there are segments of the deep tech ecosystem where the actual cutting edge is still not represented in the listed markets in India yet, but the support ancillaries, the tier one, tier two supports like energy, like EPC contractors, like cables, and so on. There are some opportunities there. So those are also benefiting out of the sort of global narrative around these themes. And last but not the least is defense, which is, again, thanks to the geopolitical scenario we see across the world, including in the Indian subcontinent. It is a near tautology to say that defense expenditure globally will go up. There is talks that US defense expenditure is going up to $1.5 trillion, close to double of what it was, 2 or 3 years ago. And every country in the world is upping its expenditure on defense. So that's the other area. So I think inflation, tech and tech-enabled areas, and defense will be the three big themes that will animate markets in the next few years.
Okay. So, Somnath, right now let's talk about how you are structuring the portfolios there at ASK Private. What is the proportion that some of these themes find in your current portfolios? Are you looking to add more here? And, would you do it because there are sectors of today and sectors of the future? Would you be willing to pay slightly higher valuation for some of these themes, like tech, like renewables or internet, fintechs which are listed?
Yeah, yeah. I would probably consider listed fintech as different from the areas that I spoke of. But broadly, yes, from a client allocation standpoint, we are looking at oversized exposures to inflation, oversized exposures to tech and tech-enabled areas like energy, materials, tier one ancillary suppliers to things like data centers, etc., and defense. So these are themes that we are extremely positive on, and hence we are increasing allocations too. There is also a sense that some of the global disruptions that are happening will finally make its way towards some sort of revival in manufacturing. It is still a work in progress. It is still something that we have to see how it pans out, because remember, the original China plus one theme didn't really benefit India so much. It benefited Vietnam a lot more than it benefited India. And India probably was one of the lesser beneficiaries of that. And it's been, what, 5, 6 years that that theme was in play. However, it looks like in the change scenario, with supply chains being disrupted globally and there being a widespread focus on building redundant supply chain, there will be opportunities across the board. And India will be one of the few places where there is a breadth and depth of manufacturing ability, even if it's not the most efficient in the world, but there is the availability of that breadth and depth of manufacturing capacity, and India can benefit out of that. So that's a great promise. And one early green shoot of that is actually defense. Defense exports from India have gone up several dozen times in the last 7 or 8 years. Some of it somewhat structural, offset obligations and so on, but some of it simply the function of lack of global manufacturing capacity in several lines that can get replicated across the board in other areas as well. So those are the areas where we are focusing a lot more of our client monies on. And we are clearly looking at that rather than pure index investing. I think in the next few years, we will also see as a meta theme a comeback of active management on equities. We've seen in the last 7 or 8 years, active managers really struggling as a group to outperform indices consistently. But I think next couple of years, as the index itself struggles to reorient itself to the new themes that come in, I think it'll be even more important for active management to play a part. So we are very active in terms of our allocations thereof.
Oh, I couldn't agree more, Somnath, and that's a great point as well. It is all about active management. Last couple of years, I mean, I think investors are feeling that it's better off buying an index fund. But again, India is that kind of a market where if you're with the right mid or small caps, you've hit a home run. Otherwise, you keep struggling with the index. That's
Yeah.
what the last almost 2 years have taught us, right? So, on defense,
That's
just a
right.
follow-up question there. Now, defense offers a whole plethora of companies. You could be with very large contractors, state-owned contractors. You could be with privately owned smaller companies. Where do you see the better opportunity?
I wouldn't be able to speak on specific stocks, but by and large, defense is one space which, again, is not terribly well represented in the listed markets in India. A lot more than deep tech is, the number of companies and the size of that market cap that is available for fishing into is rather more than the case with deep tech or data centers or AI in India. But it's still not a massive segment in the listed markets. But the good news is, in the next 2 or 3 years, there are lots of very interesting companies that are in the supply chain. When I say supply chain, I mean the supply chain of listing. And we should see a lot bigger pool of investable ideas to pick from. Second, a lot of the companies, including state-owned companies, are finally shaping up. One, because of the geopolitical pressures that are forcing people to simply crank up production, crank up efficiencies. And second, as I said, this is the one area where China plus one, while it was never really China plus one, but essentially the presence of a deep and wide manufacturing capacity, the first green shoots of benefit to India are seemingly there, as can be seen from our defense export numbers. So the companies also see that opportunity. And a lot of the state-owned firms are also shaping up in terms of expanding capacity, incurring R&D expenditure. We've seen one or two state-owned companies incur significant R&D expenditure, which is compared to their own historical precedents, which is a big departure from what is the case generally with state-owned companies in India, and even more so with corporate India, where R&D expenditure is a very small part of total revenues or total expenditure of companies. So some of those are really good portents for the next few years. So yes, some of these companies, including in fact the state-owned listed companies, are seemingly quite rich in valuations. But at the same time, the opportunity is massive. The sort of defense recapitalization requirement that is there globally. And it's not just very often defense gets conflated, or the opportunity in defense gets conflated with large platforms that are exciting, whether these are aircraft carriers or fighter aircraft and so on. But the big opportunity is in terms of replenishment, ammunition. Magazine depth is one area which got discussed time and time again in the conflict that we saw in Iran, as also the conflict that we are seeing between Ukraine and Russia for the last 3, 4 years. Even the massive and well-funded American military industrial complex has struggled with this concept of magazine depth. Essentially, do you have enough missiles to sustain a certain fire rate for a long conflict? Nobody seems to have that manufacturing capacity. There are European niche manufacturers of tactical munitions whose order books today, if you place an order today, you'll start getting deliveries 6 or 7 years later. So there's a massive opportunity globally that is opening up. The early green shoots of that is already accruing to some Indian companies. So that will only expand in the future, both global as well as the fact that we need to spend more. India needs to spend more. We are already the fourth or fifth largest defense spender in the world, and given our geopolitics, we'll certainly spend more in the years to come.
Absolutely, completely see that you are fully convinced with the defense opportunity in the coming years. Somnath, time only to discuss one more sector maybe today, and that has to be financials. And with that, I'll pull you back to the, the main indices, because there's enough and more representation of financial stocks out there, right? And this is also a very, very wide universe between traditional banks, NBFCs, and gold financiers. You name it, and of course some fintechs here as well. Now we have a huge IPO coming in the form of NSE. So just cut up the financial piece. What are you telling your clients to own here?
Financials are well positioned, especially the lenders, because a couple of things have happened. One, this FCNR program of RBI kills essentially two birds with the same stone. One, of course, the primary bird to kill was the dollar supply tightness in the market. So that bit is being obviously taken care of by this program. The second bit that is being taken care of by this program is the tight deposit to credit ratio, the credit deposit ratio that has been there in the system for some time, especially for the larger institutions. So that too gets a booster dose, depending on who you believe, and going by the experience of the 2013 program. This should attract between 50 and $100 billion of fresh deposits into the system in the next 2 to 3 months. Now, that is a booster dose to the whole deposit franchise of these banks. Both of this put together are good portents of the bank, and banking is one area where even valuations are sort of, Indian valuations, even after sort of flattish markets for the last 2 years, are not what you can call as traditional value, but one of the few areas where valuations don't seem really out of whack in terms of being 2 sigma or 1 sigma out of historical average is banking. So banking is something that we are quite positive on. And so is the larger NBFCs, because typically a benign interest rate, and by benign interest rates, it's not as if rates are going to come off, but they're not going to spike up in a hurry. The impact of a more convenient deposit credit equation in the banking system typically also tends to veer on towards the larger NBFCs who typically borrow wholesale. So we are fairly constructive on banks and the larger NBFCs.
Okay, so banks and larger NBFCs. What about this whole capital market ecosystem? And what do you think the NSE IPO will do to it, just in terms of excitement levels, valuation levels?
Well, the excitement level certainly very high, given the very, very wide ownership of NSE as a stock, probably the most widely held unlisted stock in the country. I wouldn't venture too much about valuations of a specific stock, including NSE or any of the others, but broadly, from a capital market perspective, I think that's a multi-year India opportunity. Capital market plays that transcend exchanges, brokerages, asset management, wealth management. That's a multi-year theme in India. As financialization grows, the appetite for risk grows. There will be a lot more interest and a lot more business coming into these areas from traditional savings pools. So that's sort of a multi-year meta theme. Is there a tactical here and now sort of theme? Not really. I mean, specifically in individual stocks, there could be, but is this something that at a meta level looks the place to be from a tactical 6-month, 12-month perspective? Maybe not.
All right. Okay, Somnath, good conversation. Good to have you with us on Moneycontrol today, and we hope to see you more often. Have a good day, and we'll connect again soon.
Thank you. Thanks for having me.
Okay. All right. That's a view from ASK Private Wealth coming in on how they are looking at the market and what they're advising their clients to do. The market, by the way, is flat.